Hey, what's up, everyone? This is Kirk here again at Option Alpha, and today we are going to talk about weekly versus monthly options. Questions that I get all the time are one, just kind of understanding the difference between the two, and then two, how we should use them. So I've got some very cool backtesting stuff, which I'll talk to you about here in a second, just like a little case study that we can look at on the Qs, which will be helpful, I think, in just kind of understanding, how I think about it. But the first thing we have to understand is just the raw difference between these two. So weekly options last for about 8 days. That's really what happens. They come out every Thursday, or they're set like every Thursday in time. Actually, a lot of them are now coming out kind of like weeks in advance, and we have mostly, lots of reoccurring weeks happening. But most of them originally came out on Thursdays and then would basically expire on the next Friday, right? So they would last about 8 days or so as far as timeline. And so people really like them because, one, you can, get into a lot more positions. You can get into a lot different contracts and spreads, etc. And so they've really kind of grown in popularity, and this is why, because people can get into them and feel like they can do weekly income, right? The monthly contracts are usually longer, so those are really 30 to, call it, 60 or even 90 days long. So these go out far, far in time, and always, again, it's usually the third Friday of the month that these actually expire. So third Friday of the month, unless it's a holiday, obviously, and then that gets changed, right? So the whole idea here with trading weekly versus monthly is really a question of trade duration and credit that you receive. So with a weekly contract, because it's only 8 days long, you're generally going to receive less credit for a trade because the trade doesn't last too long, right? And so the idea is that you can do weekly contracts 4 times, right? And hopefully get more credit in that 4 kind of time period than you could do in one monthly contract, which might give you more credit initially, right? Okay. So I think that it's better to go when trading to go after the monthly contracts. And I'll tell you guys why I think about this the way that I do. The monthly contracts, not only do they backtest better, which I'll show you here in a second, but you're collecting more premium upfront for one single trade, right? And with the weekly contracts, yes, you collect 4 times the weekly amount that you get. So you end up actually, in most cases, collecting more money overall, but you had to do it with 4 trades. So that's really kind of churning your account and churning commissions. And the problem with weekly contracts is that they have what's called gamma risk. And what gamma risk means is that the stock is really going to move and the position is going to move really, really quickly as it approaches expiration. So with a weekly contract, you're either going to have a big loss or big profit very quickly, little time to adjust. With the monthly contracts, since you have more time, you have more time to adjust, right? And that's really the key for me, is to have that ability to adjust a position that's going against me. I don't want to be forced into something, kind of early in the cycle. Okay. So that's really how we think about it. Now, logistically, the things that we do, and let me just kind of move my sweet whiteboard. I know you guys love this thing now. I actually love doing it. I don't like wasting the paper. So logistically, how we do it is this, right? Most of our trading, let's say 90% of our trading, is in monthly contracts. And sorry if this thing's moving. I just bumped it. Sorry, it's like moving on the sea, are on monthly contracts, okay? Monthly contracts. But what we do with these monthly contracts is we enter them at higher frequencies. So like today is Thursday, right? So is it Thursday? Yeah, it's Thursday. So today is Thursday. So we'll enter a trade that's, say, 30 days out from here, right? And tomorrow is Friday, and we'll still trade tomorrow and try to increase our frequency. But now we're entering the trade that's 29 days out, et cetera, et cetera. And at some point, usually around 25 days, we cut this off and then we restart with the new monthly contract. So now we'll enter something 40 days out, then 39, then 38, et cetera. Okay. So we try to do the weekly type trading where we're trading more number of contracts, higher number of contracts, higher frequency. We just spread them out over monthly contracts, monthly installments, I guess, is what you want to say. Okay. So that's how we think about it. Now, the only time that we would use weeklies is we use weeklies for, let me do this up here. We use weeklies for earnings trades. Okay. Because earnings trades by their nature have most of the implied volatility baked into the weekly contracts. And so for those, it's not worth it to use the monthly contracts. You're going to want to use the earnings contracts that are on the weekly basis. So the frontmost weekly options, that's what you're going to want to use for an earnings trade. Okay, so that's really the only time that we'd use the weekly contracts is with earnings. Now, the most important thing I can show you guys here, and this is just one small little case study that's coming out of our back testing, is the following. So this is really cool stuff, and this is why I tell people all the time about doing the monthlies versus the weeklies. We went back and we back tested a bunch of strangles in the queues. Okay, so we did all kinds of different durations and different setups, etc. We basically back tested everything that had about a 15 to 20, 25 delta or so. Okay, so everything in this range. So a lot of tests, a couple 100,000 tests, okay, and trades. And what we found is that on average, strangles in the queues, when you did durations of about 10 days, which is about a weekly contract, okay, so on average 10 days, could have been 7 in some cases, could have been exactly 10, but on average about 10 days until expiration, so a weekly contract. We found that on average you traded about 146 times. So this is again where you start to see that the weekly contracts are definitely trading more. You're doing more weekly contracts than you are doing the monthly contracts, which was 30. We still had a lot of frequency, just like we set them up in most of our trading here at Option Alpha. But the contracts that had 30 days until expiration on average, we only traded about 118 times over the testing period. Okay, so a lot less trades, obviously less commissions. When you look at the win rate for the monthly contracts was much higher, right? So we had a higher win rate for monthly contracts than we did for weekly. This again is because of that gamma risk, because a slight movement in the stock early or late in the expiration period, which is only 10 days, can cause the thing to be either a winner or a loser, right? So the win rate was still pretty high across the board, but slightly higher for the monthly contracts at 87%. Now the cool one here is credit. Now this is the one that always screws everyone up, right? Because when you see credit here, you see that the average credit for a 10-day trade was $33. And if you multiply that out over 30 days, you can see that on a credit basis, we were taking in more credit for 3 10-day trades than we took in for one single 30-day trade. Does that make sense? Hopefully that makes sense for you guys who are jumping on live or watching this recording, okay? So you definitely took in more credit. You just didn't keep it all, okay? When we look at the annual returns, and this is on a notional basis, so this isn't on a margin basis, because margin would be much higher for these, but on a notional basis, so credit over price, you look at the annual return and you can see that even though we took in less credit, the higher win rate and the lower gamma risk for the monthly options means that we actually won at a higher rate, trading less often, slightly less often, but always getting into the monthly contracts. Now, again, going back up to what we said before, that doesn't mean that we can't do monthly contracts every single week or every single day. It just means don't do as many weekly options. Do a little bit more monthly contract trading and trade stuff that's always 30 to 40 or 60 days out. Because again, what you end up seeing is you end up seeing slightly lower credits, which is okay. And it might be kind of tough at first to understand that, but your win rates and your drawdowns are less, and your overall annual return is much higher, okay? So does that make sense? Is that helpful? Do you guys like this stuff? Give me some thumbs up or some of the hearts or something like that. If you guys are joining in live, I just want to see kind of what you guys are thinking here, okay? Sarum said, wonderful info. We'll be able to share this recording. Yep, you can, for sure. Share this with as many people as you want and just kind of spread it out there. So hopefully this was really helpful in kind of understanding kind of what the process is. Again, weekly options versus monthly options. It's not too complicated once you get into it, but hopefully this kind of mini case study here with the QQQ strangles really helps out and kind of drive home the point about why, at least on our side at Option Alpha, we prefer to do most of our trading in the monthly contracts just because of the win rates, the number of trades that we have to do, lower commissions, and obviously higher returns. So as always, hopefully you guys enjoy these. If you have any comments or questions, please let me know. And until next time, happy trading.